Now we will take a moment to introduce you to our speaker. Our speaker today will be Paula Bedford. Paula is a principal on Rehmann's Public Sector Assurance and Financial Reporting team. In her role, she most often manages and serves as a reviewer on audit and single audit engagements, working directly with her clients to build lasting relationships. Paula has been recognized for her extensive knowledge in the not-for-profit sector, often providing specific training regarding uniform guidance and implementation of new standards. Paula, you may begin the presentation.
Thank you, Darren. All right, so today I'm going to cover two of the main ASUs that are affecting the non-for-profit industry the most. One of which is ASU 2020-07, the presentation and disclosure requirements surrounding contributed non-financial assets. Some of this is already effective, and for others, this is just now becoming effective. We'll talk about what those effective dates here in just a minute. The other one is ASU 2016-02. The lease standard is finally here. For those of you that have been around the accounting industry for a while, this one has been looming over us for years. And now it's finally the time for this one to get implemented. Good or bad, this needed to happen. And then lastly, we'll talk about some of the various COVID funding that is still impacting the NFPs in the past year, making sure that we are keeping our eyes on it and ensure appropriate financial reporting is being done over them. All right, before we dig in, we'll kick it off with our first CPE prompt. It says, where are you joining us from today? All right, so we are going to start with ASU 2020-07, the contributed non-financial assets. In September of 2020, the FASB issued ASU 2020-07, presentation and disclosures by not-for-profit entities for contributed non-financial assets. This new standard was bringing forward new presentation and disclosure standards for what many organizations refer to as gifts in kind or in-kind contributions. This standard was set up for changes in presentation and disclosure only. There is no change in how in-kind contributions are being recognized or the measurement of them. Therefore, no changes to how an organization is actually reporting these transactions. This standard is effective for fiscal years beginning after June 15th, 2021. So this became effective with those June 30 fiscal year ends and continued through obviously the rest of the fiscal year end. So 9/30, 12/31s are coming and your 3/30s as well. So as I said, the calendar year organizations are working through this implementation now. So for those of you that are December 31's year ends, let's list it up so we can help make sure you get through this in the most effective, efficient way possible. All right, so what is the definition of contributed non-financial assets? These represent such items as fixed assets, which would be land, buildings, equipment, or other items along those lines, uses of those fixed assets, materials and supplies, so potentially food, clothing, medical and pharmaceutical equipment, intangible assets, and of course, contributed services. But not just any type of service is considered a contributed service. This must be a specialized service that requires a specialized skill or background in order to perform those services. So what does this standard not address? Donations of stock or cash, as those are financial assets. So just keep in mind, this one is talking about the non-financial pieces within the standard. So why is this standard being implemented? This standard was implemented more so as a regulatory and legal push to provide more transparency within an organization's financial reporting. There was a concern that the lack of transparency with the reporting of the amount of non-financial assets received and how they're being used in the programs was not very clear. And also, places were having a hard time determining if the contributions that were being received, if they were actually being used in programs or if they're being monetized. And if they're being monetized, what type of policy do they have surrounding that piece? In addition, we are now looking for more transparency in the way in which these items are valued. So how is fair value being measured for each asset? All right, so on this slide, I have what was the old disclosures and what are the new disclosure requirements. So exactly what changed and what will the users of the financials see that is different than in the previous years? In the existing standard, it addressed requirements for disclosing recognition and measurement of contributed services. It did not specifically address presentation requirements for all contributed non-financial assets or specific requirements for contributed non-financial assets other than contributed services. In the previous standard, organizations were required to disclose the nature and extent of the contributed services received, along with the amount of revenue that was recognized. Organizations were encouraged to disclose the fair value of contributed services, but not recognize as revenue. So an example of this would be volunteer time. Volunteer time typically would not meet the definition of a contribution that would be a contributed service, as there's generally no specialized skill involved with volunteering one's time to help out at an organization. However, for many nonprofits, volunteers are a vital part of what is needed for organizations to function and provide their services. So having this disclosure is helpful to the user of the financial statements to get a better picture of what it really takes to run the organization and the programs. So now let's talk about what is changing. Contributed non-financial assets must be presented as a separate line item on the statement of activities. So this has to be separated out from the organization's financial contributions. And I will show you an example of what that would look like on a standard financial statement. Disclosures within the footnotes must be disaggregated by category of non-financial asset. So what type of asset did you receive? Food, clothes, books, services, other? Yes, you can use other as a catch-all for the smaller pieces to combine them under one grouping. Are the assets being used by the organization or are they being monetized? If monetized, it is recommended that the organization have a written policy in place for this, and it should be disclosed in the footnotes. Disclosures should also note if any of the items have donor restrictions present, and what are those restrictions. The valuation techniques used to value the asset and the inputs used to arrive at the fair value should also be disclosed. Should also be disclosing what market was used to arrive at fair value. Was it a principal market or most advantageous market? So all of these pieces now are going to be flowing into your financial statements for the users of your financial statements to read. All right, so I did put together an example of what the presentation and disclosure could possibly look like for an organization. Like I said, this is a made-up scenario, so this is actually not a real organization. And just remember that each organization is unique and each will have a different set of assets that would need to be disclosed. The left side shows the separate presentation on the statement of activities. So you can see the line in the blue is where we are separating out what those contributed non-financial assets are, separate from the traditional contributions that would be your financial pieces. The right side shows a policy note about the contributed non-financial assets by including the type of assets that they receive, how they are valued, and what the assets are being used for. In this case, they are not monetized. It also notes the donor restriction that is placed on the food and non-food items. The format in the footnote presentation is entirely up to the organization and how they would like to see this presented. It can be in a table format or a paragraph form, whatever works best. I know a lot of times the tables are easier to read and they make it easier to tie back to the amounts that are listed on your statement of activities. Now, let's just walk through quickly when to record these transactions. You'll record a contributed service when, You'll record a contributed service when that service creates or enhances non-financial assets. To be a contributed service, it must be a service that requires specialized skills and are provided by individuals possessing those skills. And they would typically need to be purchased by the organization if they are not donated. So a lot of times organizations will usually see these in a form of lawyers, doctors, accountants, or other professionals providing services to our organization. I would like to say that I am a very great Googler and I can figure out how to do a lot of things myself, but I am not considered an expert in law or carpentry or items like that. So anything that someone like me would provide, that would not be a specialized service since I do not have skills or background into that. I'm just very good at Googling how to do stuff like that. All right, so contributed goods. When do we record these? You'll record the contributed goods when the organization has discretion in its use or distributing of the contributed good. Discretion equals variance power. When a good is considered when is a good considered a contributed good? When the risk and reward of ownership over the contributed good lies within the organization. Typically, this means physical possession of the good or constructive possession, so you're able to work on it. All right, so here's our second CPE prompt. What motivated you to register for this webinar? Okay, so to wrap up this standard, I wanted to point out a few contributed non-financial assets that are typically and sometimes get easily overlooked by organizations. Advertisement and media. So this would be airtime, TV or radio, social media advertisements, magazine or newspaper ads. All of those things could be contributed services, and a lot of times they are, just so that other organizations can show their support for their local organizations in their community. Uses of facilities or utilities, office spaces, under market value rent is also a contributed non-financial asset as well. So take that into consideration if you're receiving a significantly reduced rent, per se, on your office space that would be below market. Personnel. Do you get to use staff from another organization for free or possibly discounted rates? Fundraisers. Several items are generally provided as donations for fundraisers. And then administrative costs. So again, are you getting goods or services for free or discounted rates here? All right. So now we are going to move on to the big ASU. So ASC 842 leases. Leases, it is finally here. So like I said, we have all been waiting for this one. anxiously waiting for it to come out. The standard came out to us in 2016, and after several amendments and delays, the standard is now effective for the non-public entities to get on board. While all of the private companies did implement this, some of the private companies and non-public ones did take the leap to early adopt the standard, but many did not. So for those with calendar year ends of 12/31/22, this is the year in which the full impact will be hitting your financial statements. And as a reminder, this standard supersedes ASU 840, so the previous lease standard. This lease standard is effective for fiscal years beginning after December 15th, 2021. So calendar years 22 and fiscal years ending in 2023 will be implementing this one coming around here soon. What exactly does this lease cover? It covers all tangible property, plant, and equipment. It does not cover leases of intangible assets, leases to explore or use mineral oils, natural gas, other similar resources, leases of biological assets, leases of inventory, leases of assets under construction. Additionally, this standard mostly impacts the lessee side of the transaction. While the lessors are impacted within the standard, their changes with the standard are not as significant as those for the lessee. So that is where I will be focusing today with this presentation. And as a reminder, the standard is very comprehensive. I'm only going to be scratching the surface for implementing the standard in the first year. But keep in mind, there are several pieces to the standard that will continue to impact each entity in the future years. So when lease modifications and various changes happen to come up, there's lots of new things that will need to be put into place in your years, continuing after this first year of implementation. All right, so what is a lease? The definition of a lease is a contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment, and identified asset for a period of time in exchange for consideration, such as a lease payment. The main part of focus on this standard is that it conveys the right to control the use. So control the use of the asset. In the previous standard, ASC 840, the definition was to convey the right to use the asset. All right, in the previous standard, the critical determination was whether a lease was a capital lease or an operating lease. Under the new standard, ASC 842, the critical determination is whether a contract is or contains a lease. Because lessees are now required to recognize lease assets and lease liabilities for all leases. So all leases that are greater than 12 months. So short-term leases do not need to fall under the standard. So this is talking about any lease that would be greater than the 12-month timeframe. The fact that a contract is labeled a contract, or it mentions that is a lease within the actual agreement does not necessarily mean that the arrangement is or is not a lease. Therefore, the organizations that have entered into the contract must carefully analyze the terms to determine whether the arrangement conveys the right to control the use of an asset. Executory contracts for services that involve the use of equipment but do not convey the right to control the use of the equipment to the customers are not leases. And these would be accounted for under service agreements. So again, keeping in mind the whole determination here is the right to control the use of an asset. So the flow chart on the right helps to follow through the steps in determining if your contract contains a lease or not. So I will walk through this in the following few slides. Okay, so starting at the top, is there an identified asset? An asset can be either implicitly or explicitly stated in a contract. Even if an asset is specified, a customer does not have the right to use an identified asset if the supplier has the substantive right to substitute the asset through the use of the period under term. And we'll talk a little bit more about that on the next coming slide. So that was step one. So you need to identify if there truly is an asset in place. Ideally, the asset would be specifically listed out within that contract. But sometimes they are not very easy to read and they are buried in there. So it does take a read through a few times to actually figure out what the asset is in place. Step two, does the customer have the right to obtain substantially all of the economic benefits from use of the asset throughout the period of use? So what is substantially all? So the GASB does not, the FASB does not define the guidance of what would substantially all mean. But reasonable approach would be to conclude that that would mean 90% or more. So you'll notice, and throughout this presentation, the wording substantially all or reasonably certain is used a lot. So that is, like I said, is not clearly defined, but a lot of times the rule of thumb, a 90% threshold would be a great benchmark to use in that. So additionally, in order to determine if the customer has the right to obtain all of the benefits, the customer can obtain economic benefit either directly or indirectly by using, holding, or subleasing an asset. All right, and here's our third CPE prompt. What is your preferred social media platform? Okay, so let's talk about these substitution rights that I mentioned on previous slide that are sometimes written into a contract for the suppliers. A substitution right is substantive when both of the following conditions are met. The supplier has a practical ability to substitute alternative assets throughout the period of use. The customer cannot stop the supplier from substituting an asset. An alternative asset may be readily available that the supplier has, or sometimes the supplier can quickly get one sourced out. And the other condition is the supplier benefits economically from the exercise of its right to substitute the asset. The benefit for them to do this exceeds the cost in the situation. The evaluation of the rights to determine if substantive is done based off of the facts and circumstances at the inception of the contract. So you must exclude any considerations of future events when you are making this determination if the substitution right is substantive. Okay, coming back to this flow chart. So let's assume that in reviewing the contract, the response to step one, is there an identified asset? was yes. And step 2, does the customer have the right to obtain substantially all of the economic benefits from the use of the asset through the period, was yes as well. So now we'll move on to step 3. Does the customer or the supplier have the right to direct how and for what purpose the identified asset is used throughout the period? When evaluating this step, the focus should be on whether the customer has the decision-making rights that would most affect the economic benefits that will be derived from the use of the asset. The decision-making rights that are relevant depend on the nature of the asset and the terms and the conditions of the contract. So in this instance, in step 3, you are either determining if the customer has the right to direct how and for what purpose the asset is used, or the supplier is. And depending on what your answer is there, that's the way that we would go on this chart. So if the answer is the customer does, then the contract contains a lease, and ASC 842 does apply. If the answer is the supplier does, the contract does not contain a lease. However, in some instances, it is neither. And then we'll have to move on to the next step. So step 4, does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change the operating instructions? Again, this is more so placing the right to operate and the right of use towards the customer. So if yes, the contract contains a lease. And if no, we move on to the next step. So step 5, does the customer design the asset or design specific aspects of the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? So if the answer is yes, that the customer does do that, then it does contain a lease. If it is no, then it does not contain a lease. So again, there is lots of help within the standard that addresses how to go through this determination to determine if the contract is a lease. It is very helpful to have that standard up when analyzing this. And each organization, each contract is written differently, and each will kind of follow through its own path here. So just keeping that in mind, there is no contract that is written the same. Okay, lease classification. So in legacy GAAP, so old GAAP, there are 2 types of leases: capital or operating. Under ASC 842, classifications are now financing or operating. The bright line testing between what was capital and operating has gone away. And now there's new criteria to determine what would be considered a financing lease. But some of that same criteria used in the older GAAP is still present in the new GAAP, but again, the FASB takes out like the very direct wording of 70%, 90%, and they are using the words of substantially all, reasonably certain, things like that. So all things that you need to keep in mind here. So to be classified as a finance lease, it would meet any one of the following criteria. So it just has to meet one of these. The lease transfers ownership of the asset to the lessee at the end of the lease term. That was one that we've seen in the older GAAP as well. The lessee has an option to purchase the asset and the lessee is reasonably certain to exercise that option. So again, the reasonably certain wording is added in here. And the lease term is for the major part of the remaining economic life of the asset. Number 4, present value of the sum of the lease payments equals or exceeds substantially all of the fair market value of the asset. The asset is such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease. So number 5 is the big one that is pretty different than what the old GAAP did mention. And if none of these are met, it is considered an operating lease. All right, this is our 4th CPE prompt. Are you still there? Okay, we are now going to dig into the lessee accounting side of this new standard. This chart shows an overview comparison of accounting between the 2 classifications, so the operating lease and the financing lease side of things. So starting at the top, the initial recognition and measurement for these 2. This is the same for both operating and financing leases. You will need to measure the right of use asset and the lease liability at the present value of the lease payments to be made over the lease term. The present value is determined using a discount rate as noted in the contract or the risk-free rate, which we'll talk about more in a bit. And in the next few slides, we'll also go into detail on what actually makes up the calculation for the lease liability and the right of use asset. So moving down, for subsequent measurement on the lease liability, so this would be your end of year 1 and moving forward into the future years of the lease term. From an operating lease side, you measure the lease liability at the present value of the remaining lease payments using the discount rate at commencement. From a finance lease side, you accrete the lease liability based on the interest method using the discount rate determined at the commencement and reduce the lease liability by the payments made. So similar to what you would do with your traditional debt payments that you make, where your principal is reducing that obligation. For subsequent measure on the right of use asset, so again, this would be at the end of year 1 and moving forward. On the operating side, measure the right of use assets at the amount of the remeasured lease liability, adjusting for any lease incentives, prepaids or accrued rents, any unamortized indirect costs, or any impairments that would be noted within the asset. On the finance side, you amortize the right of use asset over the shorter of the lease term or the useful life of the right of use asset and record any impairments of the right of use asset as well. The income statement effect on an operating lease side is very similar to impact in the previous standard. You will see the straight line expense hitting the statement of activities each year. On the financing side, the effect hitting your statement of activities will be slightly heavier in the beginning years and will be reduced later as your lease carries on. So similar to how you're paying down on your traditional debt, on how it would look on your books with more interest expense being hit in the earlier years and less in the back end as you are paying on more principal part of that balance. Okay, so let's focus on how the lease liability is being derived. At the commencement date, a lessee initially measures the lease liability at the present value of the lease payments to be made over the lease term. So what exactly is the commencement date? So the date on which the lessor makes the asset that is subject to the lease available for use by the lessee. This is not always the date in which your rent or lease payments become due and payable. So think prepaid rent or deferred rent if you happen to get free rent for a few months when entering into this contract. So the commencement date is the date on which the asset becomes available for use by the lessee. What is the lease payment? So payments made by the lessee to a lessor relating to the asset to use during the lease term. And these lease payments are made up of various criteria. So the first part is the fixed payments as stated in your lease agreement. So generally in every contract that is a lease, there will be a specified payment that must be made throughout the duration of your contract. So you start with that payment and you must back out any other lease incentive paid or payable to the lessee. So lease incentives are removed for determination of any lease payments. And then you would include any variable payments noted within the agreement as well. So any other payments that listed in there that are stated that you must pay throughout the term of the contract. You would include the exercise price of the purchase option, if there is one in the agreement, and if the lessee is reasonably certain to exercise that option. So again, reasonably certain is the key term here on if the lessee is going to utilize that option to purchase. And this is something that you should consider when you're entering into the lease. And then payments for penalties for terminating the lease. So again, only if the lessee is reasonably certain to terminate the lease. So at the time you're entering into the contract, if you as the lessee know that you plan to terminate that lease early, you would account for any of those payments and penalties within your lease payment calculation at the start of the lease. And then fees paid by the lessee to the owners of a special purpose entity for structuring the transaction. So got any other additional fees that you needed to pay in advance to get this transaction moving. And then amounts that are probable that the lessee will owe under any residual value guarantees within the asset. So continue with more details on this lease liability. So the discount rate. We did mention this earlier in using this rate to calculate the lease liability and the right to use asset. The discount rate for the lease is a rate implicit in the lease unless that rate cannot be readily determined. I know just by looking at many of leases, a lot of times that rate, that discount rate, the interest rate is not actually listed in those agreements. So this is where you have the second part of this. If the rate cannot be readily determined, the lessee is required to use its incremental borrowing rate. But notice, there was an amendment. So with the release of ASU 2021-09, the discount rate for lessees that are not public business entities, a lessee is permitted to use a risk-free discount rate for the lease instead of its incremental borrowing rate. So this would be an accounting policy election that would be made by the organization, and it is being made by the class of the underlying assets. So this would be something that you would elect to use in order to use that risk-free discount rate instead of your incremental borrowing rate, if there is no actual rate that is listed out within that contract. So, and as the standard says, the lessee is still required to use the rate within the lease if it is readily determinable. But if not, then you can use your risk-free rate election. Okay, so the last piece of this lease liability, the lease term. The lease term is the non-cancelable period for which the lessee has a right to use an asset together with all of the following additional pieces. So periods covered by an option to extend if the lessee is reasonably certain to exercise that option. Period covered by the option to terminate the lease if the lessee is reasonably certain to exercise that option. And then periods covered by the option to extend, not terminate the lease, in which the exercise of the option is controlled by the lessor. So again, as you remember, criteria that we use in determining the lease payments is also flowing into here. So if you're not using the options to extend or terminate the lease payments, then they should not be used here in the lease term as well. All right, so let's talk about the right of use asset. And a lessee initially measures the right of use asset at cost, which consists of the following: the lease liability. So we just talked about all those pieces that pull into that lease liability calculation. So the lease liability must be determined first prior to calculating your right to use asset. And then plus any lease prepayments. So these are typically noted out in the lease itself, which you would have to pay ahead of time, plus any initial direct costs. So these are any incremental costs of the lease that would not have occurred if the lease had not been obtained, less any lease incentives received, which then equals your right to use asset. Okay, so subsequent measurement, how you're accounting for this. From an operating side, a lessee recognizes the single lease cost for an operating lease on a straight line basis. And then from a finance side, a lessee recognizes amortization of the right to use asset and interest on the lease liability. So you have the amortization of the right to use asset typically done on a straight line basis, unless there is another basis that is deemed more appropriate, but generally this is a straight line basis. And then you'll also have the lessee amortizes the right to use asset from the commencement date of the earlier of the end of the useful life of the asset or the end of the lease term. All right, so CP prompt number 5. Which areas do you need support with? All right, so now onto the part that people really want to know. How is this going to look in my financial statements? And essentially, what is this going to do to my financial statements? How are the users going to view this? So on your statement of financial position, so your balance sheet, this is where you're going to see the biggest impacts. For both the finance and operating lease, you'll see your right to use asset. However, in some instances on the finance side, you could put the right to use asset as part of your net property and equipment. And then both will have a line for the lease liability. On the statement of activities, from an operating side, the lease expense will be included as part of expenses. And from a finance side, the lease related amortization and interest expense will be presented as well, and those should be on separate lines. In the cash flows from an operating side, you'll see the cash payment for the lease presented within the operating activities. The changes in the right to use asset and lease liability is change in net assets, then any non-cash activity is appropriate. From a finance side, you'll see the cash payment for the principal portion presented on the financial activity section, and then any non-cash as well. And now everyone's favorite part of this disclosure, this standard is the extended footnote disclosures. This will probably add a couple pages into your financial statements, and definitely will take some additional legwork to get pulled together. Okay, so I wanted to take a few minutes to show you what some possible examples of how this might look within an organization's financial statements. Again, this is just a fictitious organization, and I just wanted to show you more so as an example of what could be presented here. So you can see the separate line item for the right to use assets at the top under the asset part. And then they have separate lines for the finance lease obligations and the operating lease obligations. In this instance, this is a classified balance sheet. So the current portion and the long-term portions are separated out. It is required that the financing and operating pieces of both the right to use asset and the lease liability be presented separately in the financial statements. So rather that be on the face of the financial statements, or you can disclose that within the footnotes if you want to put them on a single line item. But again, they do need to somehow be broken out and then reconciled that way. Okay. And then in the footnotes, since it is required to have it broken out to show where the right of use assets are being presented on the balance sheet. So this example shows where the operating piece is sitting and the financing piece sitting for those right of use assets. And then you have to also disclose your net lease costs that are hitting into your statement of activities from the expense side during the year. So you see the various components in this situation that would need to be presented. So the operating lease costs, the financing costs, which would be your amortization and your interest, and then any, if you have short-term leases as well that are not being included on your balance sheet. And then some additional information on the leases that would be disclosed as well. So your cash amounts paid, any new right to assets obtained during the year, and for if there are for obligations as well, your weighted average remaining lease term and your discount rate used for both the finance and the operating leases. Again, each those pieces should be separated out. And then another piece, which is pretty consistent with the previous standard, the future payment schedule of the leases broken out by the type of the lease, so the finance or the operating piece. And then this would tie back to the lease obligations that you have presented on your statement of financial position. Okay, so we learned about what a lease is and how to calculate it and disclose it. And now we're going to go over how to adopt it in your financial statements. There's a couple different transition methods that could be elected. So you could do a retrospectively approach to each prior reporting period presented in the financial statements. So if you are doing comparative statements, and then under this method, you would adopt ASC 841 as of 1/1/21. Or you could do it at the beginning of the period of adoption. So this would be adopted at 1/1/22. So either way, so if you want to go back to your prior period that's being presented, so you have 21 and 22, that'd be January 1st, 21, or if you just want to do the beginning of period adoption of 1/1/22. And then there are some practical expedients that can be elected here upon implementation. The first item that I note here is a package of 3. So it's a all or nothing election. The organization need not reassess whether any expired or existing contracts are or contain leases. The organization need not reassess the lease classification for any expired or existing leases. And the organization need not reassess initial direct costs for any existing lease when determining the right of use asset. And then also another expedient is the use of hindsight in determining your lease term. And then whether not to assess whether existing or expired lease easements that were not previously accounted for under the old standard contain a lease under the new standard. So again, any of these expedients that you do elect, they do need to be noted and disclosed within your financial statements as well. So I decided to pull a slide in here to help organizations get started with looking to see where you might have a lease within a contract. As we talked about, not all contracts contain leases, and some contracts contain leases which are not easily implied within the contract. So these are just some questions that will help generate which contracts to pull, or if you have these type of contracts within your organization, to look for potential leases that are out there. All right, and then our last CPE prompt for today. How are you feeling about the topics? Okay, so COVID funding. I just want to touch briefly on some of the COVID funding that we're still seeing around nonprofit organizations and how they are impacting these organizations. So the first one is this provider relief funds. So several organizations have been seeing these payments come through and for some time now. As the chart notes here, they were coming in as early as April of 2020 and continued into 2022. Reporting for these funds are still happening now, still being used now, and a lot of the reporting is obviously still happening now. The reporting for the funds is driven by the Health Resources and Services Administration. And the chart that's up here is taken from their website. So I'm sure those of you that have received these provider relief funds have seen this chart and know this chart well. So this chart does list the reporting periods for the portal and for the periods of which they should be reported within the entity's financial statements or their CFA if an organization is getting a single audit. And keep in mind, the portal dates and the financial reporting dates do not always align. So this does cause some questions and some finagling in how that breakout and tie back to what is being put in the portal and what is being put on the CFA, and then what's being presented just within the financial statements. But there should be some methodology for how all of that kind of aligns together. And then keep in mind, these are federal funds. So any organization spending over $750,000 within their fiscal year must have a single audit. And then a few other COVID-related fundings that we've been seeing over the past couple of years and still expecting to see in this current year. So we talked about those provider relief funds, Medicaid cluster, federal transit cluster, and the emergency rental assistance. So all of these have some aspects of COVID funding that are being pulled into them. So kind of what does that mean to you? That means that these are deemed higher risk by the federal government. So any COVID funding is triggering for higher risk. So more scrutiny by the government and more scrutiny by any of your auditors as well. And then things to remember, remember to apply ASU 2018-08, which is your reporting standard for nonprofits in regards to contribution and revenue recognition. So typically, a lot of these fundings are going to be considered conditional contributions. And also remember with the 750 threshold that would trigger a single audit, there are a lot of organizations that typically have not had single audits in the past, but now are receiving this additional COVID funding, which are triggering that. So again, just making sure if you are seeing any of these fundings coming through, you know exactly what needs to be done from an operations and reporting side of this. And so that is all that I have today. I know I did cover a lot. The lease standard, like I said, is very comprehensive, and I only just touched the surface of it. So please reach out if you have any additional questions in regards to anything that I presented today. And I do appreciate your time. So I'll turn it back over to Darren to close us out.
This concludes today's program. Thank you for joining us. With respect to people's time, we'll be reaching out directly to answer all the questions submitted. If you'd like to learn more, please visit Rehmann's website at www.rehmann.com, or you can also email us at publicsector@rehmann.com. Thank you and have a great rest of the day.